Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another edition of the Weekly Economic Review, this time for the week ending October 22nd, 2021. So let's start, as usual, with a quick look at this week's market activity. So negative for bonds, positive for stocks. The highlight on the week was that the U.S. Stock market outperformed slightly, but year to date, close to 25% now for the TSX beyond other markets. So 2021, as we expected early this year, seems to be the year of the TSX. Oil prices higher, Canadian dollar not going anywhere on the week, and price of gold slightly higher. So now I get a lot of questions about housing, so I thought that I might focus on that issue this week. So housing prices year over year are growing at the fastest clip in 20 years. So right now it's 17.3% growth annually for the Terranet National Bank Index. So that's for Canada as a whole. So prices are growing at a fast clip. Change in habits, so the move to the suburbs because of the pandemic, the rise in the cost of lumber. So many effects push the price of housing higher. We've discussed that in the past. You all have a few ideas on why housing has pushed so far, but the message here is that we do start to see a peak. So there's this saying in economics that the cure for high prices is high prices. So the fact that prices rose fastly, very quickly over the last 2 years, well, it means that now we're starting to see a moderation of that. So month over month, as you can see, the core of the growth in housing prices was in mid to early 2021. So these are monthly changes, and now for the last month, as you can see, it barely moved 0.1% higher month over month. So it seems that we're starting to peak here. That's very good news. So if we look city by city, I picked the main ones here. So Toronto, these are price indices, by the way. This is not growth. This is price indices. So as you can see, the price in Toronto accelerated very quickly, and we're sitting at the highest level of any city right now. Vancouver is second, so we also did have some acceleration of prices early this year, but we're starting to see the prices in Vancouver come down month over month, so that's the good news there. Montreal going sideways or even down. Montreal is the red line, and on the bottom, Calgary with different economic challenges. We still had some good growth in 2021, but it seems that in all of these cities here, we're starting to taper off. So that's the good news. We might have seen the worst of the acceleration in housing prices. Then now maybe the market is due for a breather. So we don't think we're in a housing bubble. Housing bubble is something different than that. There are many reasons that have supported growth in housing over the last few years. And now if we do see a peaking a pattern coming in, that reduces the risk that we have some quick adjustments in housing prices. So financial markets, I've been talking about inflation for a few weeks now, a few months. When we look at the surveys, this is the fund manager survey from Bank of America. So we always like to look at that to see, well, what's the market psyche these days, and inflation in October. Uh, it just crowds out any other risk factor. Now everyone's looking at it as inflation as being the biggest tail risk in the market. So China is second, asset bubbles, Fed taper after, but inflation is way above. So the risks are that if inflation surprises to the upside more than what happened recently, it could lead to some volatility in interest rates, so volatility in bond prices. That would lead to volatility in stock prices, and also if you're a bottom-up stock picker and you look at that, well, you need to ask yourself, well, is this firm, will this firm be able to pass on the rise in its costs to its consumer? So does it have pricing power? If so, that's a good thing. It will raise its earnings. But if not, you could have a good a strong hit on profitability, profit margin of the firm. So that's kind of the question that everyone's asking. So that's why it's become a very important risk for the markets. But even given that, I mean, there's always some risk in the market. If you wait for the market to be riskless to invest, you'll never be invested. We have started to warm up to the stock market, we've started to put some more money at work in some of our funds. So we went from neutral to slightly overweight because of this chart that I've presented a few times over the year. The red line is 2021 market, so the pattern. It diverged from historical patterns during the summer months. That led us to be more defensive, more neutral, and we did have a bit of a correction. It was a stealth correction, so the average stock corrected, even though the index pulled back by only 5%. So we did have the correction that we expected, and now we're reconnecting to the pattern, the historical pattern here from 1990. And the Santa Claus rally is something that we joke about, but it's something that's very present in the markets in November and December. On a typical year, you tend to have some good returns going into year end. So warming up to that, of course, we don't manage only based on seasonality, but it's one part of the equation. And we did add a few percentage points to the S&P 500, to the TSX recently, to targeted bets like banks, financials in the US. So we've built a position around that. We put some more money at work, and we are going into year end right now with a bit of an overweight, but we're always looking at the risk adjusted returns and the perspectives for risk. So we have all of the tools that we need to manage risk if we're wrong and we do have some volatility coming in, but we're turning more positive going into year end. So what to watch next week? We'll have the Bank of Canada rate decision. Should not change the leading rate should not change, just at 0.25%. We'll have August GDP growth, which should be positive if we look at the retail sales that came out this morning, which were very positive. And in the US, we'll have Q3 GDP growth. Consensus is for 3%. That's a very important figure because a few months ago, the consensus for Q3 GDP growth was somewhere around 6 to 7%, and it was cut by half because of the loss of momentum. So we'll see how big that loss of momentum is. So very important data point coming out next week. So that wraps it up for the week. If you want to follow us, ia.ca/economy, please give a try to our new Economy and Finance 101 section and give us some feedback if you have feedback to share. And if you haven't done so, you can subscribe to our newsletter by entering your email in the box that you see there on the screen. So thanks everyone for following us on a weekly basis, and I'll be back again next week with another edition of the Weekly Economic Review.